Former workers of Twitter, including ex-CEO Parag Agrawal, ex-legal director Vijaya Gadde, and ex-CFO Ned Siegel, have filed lawsuits against the social media platform over allegedly underpaid legal expenses. According to the lawsuit, which was filed in a Delaware Chancery Court, Twitter must reimburse the former executives for legal costs they incurred while working for the company in order to respond to requests from the Department of Justice and Securities and Exchange Commission totaling over $1 million. For more on these headlines, we cross over to London. We're joined by Arise business analyst Bode Ososanmi. Good morning, Bode. Thanks for joining us. So at the World Bank, lots of focus seems to be on channeling funds from wealthier countries to more vulnerable ones. Why is this a challenge today, you think?
Well, it's the challenge for everyone. The economy is slowing down. You heard the projections, and the context indeed is getting also tougher. But I'm not so optimistic for developing economies because if the advanced nations could not do very, very much when the going was good, how much more now that there's so much they're dealing with, and I'm afraid they're not likely to be able to sell any support for developing nations, especially within the toxic politics that is resulting out of the difficulties in the environment. But I must say that discussions on how to help developing nations are very, if you like, fashionable. But the important thing is game-changing movement that is in the interest of the South. Of course, in many cases, these types of movements will come at the expense of developing economies, which is why you don't see at the expense of developed economies, which is why you don't see them. I listened to Mohamed El-Erian yesterday on the way forward and what he would do differently in Bretton Woods. And he said three things. One, he said he would like to see more regional lending. I would like to see just more support for emerging economies. The third issue he mentioned, or the second issue he mentioned, was to have a clearing house of ideas, especially to support those that are somewhat behind. And the third issue he mentioned is making collaboration with other institutions much easier than it has been. That is bank fund collaboration, and even collaboration between the fund and other institutions. Let me wrap up by just saying we could be having a boiling frog situation here. That's where developing nations struggle more and more. And there's a sense of the IMF and World Bank getting used to see them struggle, almost accepting this as a new norm until the frog slowly boils to death, which is why I suspect the answer for developing nations is not likely to come from Bretton Woods and maybe alternative South-based institutions like BRICS, if they can be better encouraged to thrive and expand their membership. Maybe we could get some solutions from that perspective.
We got, of course, CPI data from China. What do you make of this 18-month low?
Well, it's encouraging because, of course, as you know, whatever happens in China has a multiplier effect all over the world. So cheap goods coming from China is going to be exported to the rest of the economy. But food inflation was down to a 10-month low, 2.5% versus 2.6%, due to the higher drop in cost of fresh vegetables, although there was a faster rise in pork prices. Non-food prices also continued to ease. It came in at 0.3% in March versus 0.6% in February. Again, that is linked to declines in cost of transport, which came down. Cost of transport came down 1.9%. Actually, minus 1.9% was the reading in March compared to plus 0.1% the previous month. Core consumer prices, that's excluding the volatile prices of food and energy, went up 0.7% year on year after 0.6% gain in February. So according to analysts, they're also saying that the reason we're seeing this drop is because demand remains persistently weak. I forgot to mention PPI also came in, Producer Price Index, which is most reflective of future inflation trajectory, showing prices that factories charge wholesalers. It fell by 2.5% last month. That's minus 2.5% year on year. So there is a lot of Well, I would say good news coming from the inflation front. But the labor market is also now tightening. We've seen the decline in food and fuel inflation. But when you get tightening labor market, that has pressure on inflation, although many still see inflation to stay well below the government ceiling of around 3%, which is still much, much lower than other economies in the world. Analysts say that, yes, we will see some rebound in the coming months as the labor market tightens, and the peak at 2.3% thereabouts in early 2024. But they also point out that the low March inflation suggests there is a much bigger room for monetary policy easing to boost demand, which is still struggling. And, we saw some very tepid economic results in Q1 as well. So I think it's good news. And of course, it also means cheaper Chinese goods for the rest of the world.
U.S. markets responding to the latest jobs data yesterday. Well, jobs data was on Friday. They responded yesterday. What are we expecting to be the main drivers on the data front this week?
Well, indeed, US stocks, they kicked off the week on a softer note, and as we got Friday's March data, although the market was closed yesterday, we saw mixed reaction somewhat. As you know, the slow decline in hiring, that supports this soft landing narrative for the economy, but you still have higher job openings and unemployment rate at 3.5%, and and economic resilience, all hinting that the Fed could still have room to continue tightening. The more cyclical stocks in economically sensitive industries like energy and industrials, they led the market yesterday, while the more interest rate sensitive technology, consumer staples, and communication services saw modest falls. European shares are up today. We'll see what happens in the US markets when they open. This week, there are three broad drivers. First, the first quarter earning reports and maybe some corporate announcements. According to what analysts are expecting, we could see a sharp drop in profits as high inflation squeezes margins and tighter credit conditions persist, as well as fears of an impending recession holding back the demand. We will get the big banks, the finance giants reporting on Friday, JP Morgan, Citigroup, Wells Fargo, and BlackRock, and estimates are saying 1.6% revenue growth for S&P 500 companies in the first quarter, with earnings down 5.2% year over year. But the other thing that's going to drive the markets, corporate news. Moderna has an investor day to discuss its vaccine development. There will be some speeches from no fewer than 3 Fed presidents. Also on Wednesday, we get minutes from the Fed Open Market Committee. On data, tomorrow, the US CPI for March is expected to be out 5.2% from a year ago versus 6% rise through February. And we also get on Friday retail sales, which analysts say will be up 0.3%, will be down 0.3% from February. So there's quite a bit to look forward to, but I suspect maybe the main data item is going to be that CPI. Which, of course, is going to be of interest to the Fed. But for now, I think the mood looks somewhat calm, and I just hope we don't get some ugly surprises when we get the bank data on Friday.
All right, we'll see what the data shows. Arise business analyst Bode Ososanmi, thanks for taking us through the headlines. Appreciate your insights as always.